For decades, traditional banks were the backbone of the global financial system. They represented safety, stability, and trust. People believed that if their money was inside a bank, it was protected and working for them. Investors built entire portfolios around banking stocks, relying on steady dividends and predictable growth. But today, a quiet transformation is taking place. There are no dramatic headlines or sudden collapses driving it. Instead, capital is slowly and deliberately moving away from traditional banks. And this silent shift is reshaping the future of investing. This movement is not about fear, it's about awareness. Investors are beginning to realize that the financial world they once understood is no longer the same. The rules are changing, and so are the opportunities. Those who adapt early are repositioning their capital, while others remain stuck in outdated assumptions. To understand why this shift is happening, we need to break it down step by step. The first major factor is the reality of interest rates. On the surface, higher interest rates should be good for banks. In theory, banks earn more by lending at higher rates. But in reality, aggressive rate hikes have created pressure instead of profit. Borrowing has slowed, loan demand has weakened, and the risk of defaults has increased. At the same time, depositors now expect higher returns on their savings, forcing banks to raise deposit rates. This squeezes margins from both sides. The second reason is confidence, or more accurately, how fragile confidence has become. In the digital age, money moves instantly. When concerns arise about liquidity or balance sheets, large investors don't wait for reassurance. They move first. Even rumors can trigger massive outflows. This has changed how investors evaluate bank risk. Stability is no longer assumed. It has to be constantly proven, and that uncertainty makes traditional banks less attractive as core long-term holdings. Another powerful force is regulation. Banks operate under some of the strictest regulatory frameworks in the economy. While regulation protects the financial system, it also limits flexibility and innovation. Technology is accelerating this shift even further. Financial innovation is no longer centered in bank branches or legacy systems. It lives in fintech platforms, digital payments, online lending, and alternative financial ecosystems. Returns also play a critical role. Bank stocks were once reliable performers, offering strong dividends and steady appreciation. Today, many struggle to outperform broader market indices. While dividends remain, growth has slowed. Diversification strategy is another reason investors are reducing exposure to traditional banks. Modern portfolios are designed to survive uncertainty. By spreading capital across alternative assets, non-bank financials, and real assets, investors reduce dependence on a single system. In finance, the biggest changes rarely announce themselves loudly. They unfold quietly, steadily, and over time. The silent shift away from traditional banks is one of those changes, and for investors paying attention, it may define the next era of wealth creation.